How does the commodity cost curve explain production economics? Imagine a line that shows how much it costs to make more of a product as you increase production. That line is called the commodity cost curve. It helps us see how production costs change when more units are produced. Think of it as a map for understanding how different producers operate at various cost levels. Each point on this curve represents a producer and the cost to produce the next unit of the commodity. The curve is built by lining up all producers from the lowest to the highest cost of making the product. This way, we can see who can produce cheaply and who needs higher prices to stay in business. It's like a ladder where the bottom rungs are the cheapest producers and the top rungs are the most expensive. When market prices go up, more producers find it profitable to produce, moving up the cost curve to higher cost producers. When prices fall, only the lowest cost producers can stay profitable, and the higher cost ones might have to cut back or stop producing altogether. This pattern explains why some producers are more resilient during price drops. For investors, the cost curve shows which producers are likely to survive tough times. The low-cost producers tend to have bigger profit margins and can endure periods of low prices better. High-cost producers might make more money when prices spike but are more vulnerable if prices drop. The shape and position of the curve depend on factors like input prices, technology, regulation, and location. For example, if new technology makes production cheaper, the entire curve shifts downward. That means more supply at lower prices. If energy costs rise, the curve shifts upward, making high-cost producers less competitive. The interaction between supply and demand determines the market price. When demand increases, prices rise until they cover the costs of higher-cost producers, leading to more supply. When demand drops, prices fall, and only the lowest-cost producers stay in the market. This movement along the curve shows how supply responds to price changes. For investors, understanding this helps predict how much supply might change if prices go up or down. It also helps identify which producers are most likely to stay profitable and which might struggle. By analyzing the cost curve, investors can see where the break-even points are for different producers and how sensitive supply is to price shifts. This information guides decisions about buying or selling in commodity markets. In short, the commodity cost curve is a key tool for understanding how production costs influence market prices, supply, and investment risks. It explains why some producers thrive while others face challenges, and it helps investors make smarter choices based on how costs and prices interact.